lot of good people wait until 72 to think about their IRA. By then, the tax trap may already be building. What almost nobody explains is that the danger is not just one birthday. I'm going to show you exactly what to do before that day comes. If you've ever worried about taxes eating your retirement, hit subscribe now because I'm about to show you exactly what to do. Here's what keeps me up at night. A retiree spends 30 or 40 years doing the right thing. They save. They skip vacations. They put money into an IRA. Then one rule they barely understand shows up late in life and starts pulling money out on the government's schedule, not theirs. And the worst part is this. Many people still believe age 72 is the big deadline for everyone. That used to be closer to true for some people, but the law changed. For many retirees now, required minimum distributions start at age 73, and for some younger people it starts at 75. That sounds helpful, but it confuses people even more. Here's what almost nobody is telling you. The real danger is not only the age itself. The real danger is poor planning in the 1, 2, or 3 years before that age. If you wait until the deadline is staring at you, you may end up taking money the wrong way, in the wrong year, with a bigger tax bill than you expected. You need to understand something before I show you the solution. This is not just about taking out a little cash. This can affect your taxable income, your Social Security taxes, and in some cases, even your Medicare costs later. One move can touch everything. That is why I'm going to show you exactly what to do. Are you getting close to 72 and still hoping this will somehow be simple on its own? Subscribe now, because the people who prepare early are usually the ones who keep more of their own money. Picture this. Frank is 71 years old. He lives in Columbus, Ohio. He spent 34 years as a machine operator. He did what millions of Americans do. He worked hard, paid his bills, and put money into a traditional IRA because he was told it would help him in retirement. Frank thought he understood the rule. He believed he could wait until he was old enough, then just take whatever the bank told him to take. He figured one phone call would solve it. He was not reckless. He was not careless. He was just never given the full picture in plain English. Everything looked normal until his income changed. He sold a small piece of land, had some extra bank interest, and then delayed his first IRA withdrawal because someone told him he had until April 1st of the next year. That part was true, but nobody explained the trap hiding behind that date. What went wrong was simple and painful. By waiting, Frank ended up taking 2 required withdrawals in 1 calendar year. One was for the prior year and one was for the current year. On paper, it looked like one big jump in income. His taxes were higher than he expected, and he felt like the rules had tricked him. He kept saying the same thing over and over. I thought I was doing it right. That is the line I hear from retirees all the time. And the sad part is, this could have been avoided with 1 planning session, 1 calendar reminder, and 1 decision made before the pressure hit. Do you think you'll remember all of this later when the date gets closer? Then subscribe now, because confusion is expensive and clear planning is worth real money. Let me be very clear about what this means. A traditional IRA is tax deferred, not tax free. That means the government let you delay taxes while you were working. The rule is simple. At a certain age, the government wants some of that money to start coming back out and onto your tax return. Here's the exact number you need to remember. Under current IRS rules, many retirees must begin taking required minimum distributions at age 73, not 72. If you were born from 1951 through 1959, age 73 is the usual starting age. If you were born in 1960 or later, the age is generally 75. That one detail changes the whole plan. Now listen carefully, because this is where people slip. Your first required minimum distribution is for the year you reach your required age. But you can delay that first withdrawal until April 1st of the following year. That sounds like extra time. It sounds helpful. It sounds safe. But extra time can create a bigger tax problem. Why? Because if you wait until that April 1st deadline, you still have to take your second required withdrawal by December 31 of that same year. That means 2 taxable IRA withdrawals can land in 1 calendar year. 2 distributions, 1 tax year. Bigger income, bigger shock. This is the part nobody explains before you turn 72. Here's how the number itself is figured. In plain language, you take the value of your IRA on December 31st of the prior year and you divide it by an IRS life expectancy factor. For example, age 73 uses a factor of 26.5. If your IRA was $265,000 at the end of last year, your required minimum distribution would be about $10,000. And here's one more piece many people miss. If you do not take enough out, the IRS can charge an excise tax on the amount you missed. That penalty can be 25%, though it may be reduced to 10% if the mistake is corrected in time. That is not a small paperwork problem. That is real money leaving your pocket. Do you want to be the kind of retiree who reacts late, or the kind who plans early and stays calm? Subscribe now, because smart retirement is usually boring, simple, and done ahead of time. Scenario 1 is the delay trap. What most people do, they wait until the very last minute and push that first required withdrawal into the next year. That is a mistake because 2 IRA withdrawals can hit the same tax year and make your income look much bigger than it really feels. Here's what to do instead. Look at your full income before the year ends. If your tax picture is already manageable, take that first required withdrawal in the year you reach your required age instead of waiting until April. Now, the withdrawal gets reported in separate tax years and nothing bad happens to you. Scenario 2 is the "I thought 72 was my age" mistake. What most people do, they assume the old number still applies to everybody. That is a mistake because the law changed, and a wrong starting age can throw off your entire timing plan by a full year or more. Here's what to do instead. Check your birth year and confirm your exact required beginning age. If you were born from 1951 through 1959, the key age is generally 73. If you were born in 1960 or later, it is generally 75. Now, the rule gets applied correctly and nothing bad happens to you. Scenario 3 is the Roth confusion. What most people do, they hear IRA and assume every IRA has lifetime required withdrawals. That is a mistake because original owners of Roth IRAs generally do not have to take required minimum distributions during their lifetime. Here's what to do instead. Separate your traditional IRA thinking from your Roth IRA thinking. Know which accounts are tax deferred and which accounts follow different rules. Now, the right account gets handled the right way and nothing bad happens to you. Scenario 4 is the still working misunderstanding. What most people do, they think if they are still working part-time, they can delay every retirement withdrawal. That is a mistake because the still working delay can apply differently to certain workplace plans, but it does not rescue a traditional IRA from its own rules. Here's what to do instead. Ask one plain question for each account. Is this an IRA or is this a current employer plan? Then ask when this specific account requires distributions. Now, the correct rule gets attached to the correct account and nothing bad happens to you. Scenario 5 is the tax withholding mistake. What most people do, they take the full required distribution late in the year, spend most of it, and forget that the extra taxable income may change what they owe. That is a mistake because surprise tax bills are one of the fastest ways to ruin peace of mind in retirement. Here's what to do instead. Decide in advance whether you want taxes withheld from the distribution or whether you will make estimated payments another way. Write the plan down before the money leaves the account. Now, the taxes get handled on purpose and nothing bad happens to you. Have you ever told yourself, "I'll deal with that next year," even though deep down you know next year comes fast? Subscribe now because retirement mistakes love delay and good plans love deadlines. Most people think the rule is only about one birthday cake and one withdrawal. Here's the truth. The rule is about timing, taxes, and coordination. It is about what year the money lands in. It is about whether that income spike hurts you. It is about planning before the first check ever comes out. You may have heard that if you do not need the money, you can just leave it there forever. That is not accurate for traditional IRAs. Once your required age arrives, the IRS still expects that minimum amount to come out whether you want to spend it or not. Most people think the first deadline is the safe deadline. Here's the truth again. April 1 is legal, but legal does not always mean smart. If waiting puts 2 required distributions into 1 year, then waiting may cost more. I'm going to show you exactly what to do because timing matters as much as the amount. You may also have heard that all of this will be handled automatically by the custodian, so there is nothing to worry about. That is not a safe way to think. Your account company may calculate a number, but it does not know your full tax life, your other income, your giving plans, or your family needs. You still have to think. Do you know someone who assumes the bank or the government will warn them in time? Subscribe now because the retirees who stay informed are the ones who usually stay in control. Protection move number 1 is this. Know your real starting age before you plan anything else. Here's why this matters. If you use the wrong birthday, every decision after that may be off. Your tax plan, your withdrawal plan, your Roth conversion plan, and even your giving plan can all become sloppy from the start. Exactly what to do. Write down your birth year today, then match it to the current rule. Born 1951 through 1959 usually means age 73. Born 1960 or later usually means age 75. Put that age on a paper calendar, a phone calendar, and a note on your refrigerator. See it. Repeat it. Do not guess. Protection move number 2 is to run the numbers 1 to 3 years early. Here's why this matters. A required minimum distribution should never feel like an ambush. If you wait until the year it starts, you have fewer options. If you plan ahead, you may be able to spread income more wisely and avoid a sudden jump. Exactly what to do. Look at your latest IRA balance, look at your other retirement income, and ask what your tax return may look like when withdrawals begin. Do not try to be fancy. Even a rough plan is better than no plan. If the IRA is large, sit down with a tax professional before the first required year arrives. Protection move number 3 is to decide whether taking the first withdrawal in the first year is smarter than waiting until April. Here's why this matters. Many retirees hear, you can wait, and think that means you should wait. Those are not the same thing. The calendar gives permission. It does not give wisdom. Exactly what to do. Compare two simple pictures. Picture 1 has the first withdrawal taken in the year you reach your required age. Picture 2 has the first withdrawal delayed until the following spring, which means 2 distributions in 1 year. Choose the picture that usually keeps your taxable income steadier and lower. Protection move number 4 is to separate your accounts in your mind. Here's why this matters. People get in trouble when they treat every retirement account like it follows the same rule. A traditional IRA is not the same as a Roth IRA. An old 401k is not always the same as a current employer plan. Labels matter. Exactly what to do. Make one simple page with each account listed by name. Put traditional IRA, Roth IRA, 401k, or whatever it is next to each one. Then write the rule beside it. If you are unsure, call the company and ask for the account type in plain English. Clear labels stop expensive mistakes. Are you serious about protecting your money, or are you still hoping memory alone will save you? Subscribe now, because hope is not a plan and retirement deserves a real system. Protection move number 5 is to build a no-fail reminder system. Here's why this matters. The older we get, the more valuable simple systems become. You do not need more stress. You do not need to hold every deadline in your head. You need a repeatable process that works even when life gets busy. Exactly what to do. Set 3 reminders for every required year. 1 reminder in January, 1 in June, 1 in October. If you use a tax preparer or advisor, add a meeting before fall. Ask one question only. Have I taken the right amount from the right account in the right year? That one sentence can save thousands. One more thing that almost nobody knows about is this. If you are charitably minded, a qualified charitable distribution can be a powerful tool. Once you are old enough to use it, money can go directly from your IRA to a qualified charity, and that amount can count toward your required minimum distribution. Why does that matter? Because a qualified charitable distribution can satisfy part or all of the required amount without showing up the same way in your taxable income. In simple words, if you already give to charity, this may be a much smarter path than pulling the money out first and then writing a personal check later. Did this make you stop and think about your own IRA for the first time in a while? Then subscribe now, because small tax moves today can protect big retirement dollars later. Here's exactly what happened when Linda used these strategies the right way. Linda is 72, lives in Arizona, and has a traditional IRA worth about $320,000. She sat down the year before her required age. She checked the rule, confirmed her timing, and reviewed whether delaying the first withdrawal made sense. She saw that waiting would have pushed 2 required withdrawals into the same year, right when she also expected more interest income and a small property sale. So she took the first required distribution in the year she reached the required age instead of delaying it. She also had taxes withheld on purpose, not by accident. The result was simple but powerful. Her income stayed smoother across 2 tax years. She avoided the shock of 2 required withdrawals landing together. She felt calmer, her tax planning became easier, and she stopped saying, "I hope I'm doing this right," because now she knew she was. That is the big takeaway today in one sentence. The IRA rule nobody explains before you turn 72 is that the danger is not just the age. The danger is waiting too long to plan for a withdrawal that can raise your taxes if it lands in the wrong year. So here's exactly what to do next. First, confirm your real required beginning age by birth year. Second, list every retirement account by type. Third, decide whether taking that first required withdrawal in the first year is smarter than waiting until April. Fourth, set reminders. Fifth, talk with a tax professional before the first deadline if the numbers are large. Want to know more and protect your retirement one smart step at a time? Then subscribe, because I post new videos every week that could save you thousands. If you know someone who needs to hear this, send them this video right now. I'll see you in the next one.